Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome David Hunter, who's a contrarian macro strategist with, I think it's over 40 years of experience on Wall Street. So, David, thanks for joining the podcast today.
Yeah, thanks, Anthony. Thanks for having me.
You're welcome. So, obviously, I mentioned that you're a contrarian macro strategist. So, I guess what does that really mean?
Yeah, well, there's two parts of it. Macro strategist obviously means I focus pretty much on the macro economy and the markets and market cycles. Everything from stock market to bond market to currencies to the commodities and metals. And the contrarian aspect of it is, which probably sets me apart, is where my views tend to be pretty opposite, certainly at major turning points like now. My views tend to be quite opposite of what the consensus is. There are times in the middle of a move where the consensus and my view are pretty similar, but at the extremes, either the lows or the highs in markets, my views tend to be viewed as really out there because they're quite different than where the consensus thinks that things are going.
Yes, I guess if we look at your views at the moment, obviously there's lots of uncertainty in the market. It seems like lots of volatility in different markets occurring all across the world. So, yeah, what are you thinking is currently happening? I guess just an overview.
Yeah, well, talking about the economy, obviously things are not real good, both here in the U.S. and certainly in Europe and Asia. Australia, Canada, across the globe, it's China, everywhere seems to be slowing down and looking a lot more fragile. COVID, the pandemic threw things around, and you had a couple of years where, because of all the money printing, the globe had a rebound, and now you're running into all the inflation issues, of course, and central banks leaning against that inflation. My view is that the central banks, and the Fed in particular, is has tightened too much, and yet they're out there with pretty much every day telling us that they're nowhere near done, that there's a lot more tightening to go. So that spooked the stock market, and you've spent most of this year in a bear market. I believe last Friday, or last week, and yeah, Friday basically, we completed a retest of the lows from June, and I think we've begun the next leg up. It's not gonna be straight up, and it's not necessarily going straight from here. You may fill in the gap that you had Monday, things like that. So, but I do think we probably have seen the lows, and if by chance we haven't, which I don't think that's the case, but if by chance we haven't, the lows aren't that far down. And yet the consensus is that we have a long ways to go. I think most people think, given the Fed's stated intention to tighten for for at least the balance of this year and into the first half of next year, I think the consensus believes we're probably going down to 3,000, 3,200. I don't think that's going to happen. And in fact, I have the opposite view, where I think, like I said, we've successfully retested the lows, and that will probably, in the next 6 months, make major new highs, with my target being S&P 6,000, NASDAQ 20,000. So that's viewed right now as insanity, very extreme. But I think there's a very good chance that we're beginning that move now.
Yeah, well, I'm quite surprised to hear you say that. As you said, everyone's, I guess, been talking about doom and gloom and how they think we're going to go further and how there could be a massive catalyst like Credit Suisse or one of these banks sort of going bust. So, if something like that were to happen, do you think, you're just saying we might just go a little bit further down? We're not going to crash, like I guess some
Yeah,
people are
it's
thinking.
not my base case. I don't think we're going down, but if we go down, it's 3,500. It's not 3,000. And I don't think we're going there. When I put something like that out there, people go, "Oh, you're getting bearish." I go, "No, my high expectation is that we retested. The only reason I leave that out as a possibility is, with CPI out there next week, I think there's always that chance that you get a bad number, but and you do what you did in September. But that's not my expectation. I think we had a successful retest, and so 3,600 basically marks a low, and you go from 3,600 to 6,000. And I actually think my 6,000 is going to prove to be conservative. So as far out there as it is, I don't even think that's necessarily the high. But I do think the highs, wherever they are, probably happen in the next, say, 6 months. It could stretch beyond that, but something like that. And wherever those highs are, they are the top of a 40-year secular bull market that started in 1982. And I think those highs stand for, decades. I don't know whether that's 2 decades or 3, but it's decades. It's a long time. And there are reasons why I would believe that. But so I think we're heading for a major top. We're just not there yet. I know most people think we had that top in 2021 at 4,800, and that we can go a lot lower. And by the way, my expectation after that top is that we do have an 80% bear market. So let's say the number is 6,000. That means you could go to 1,200. So all these people thinking they're the big bears at 3,000, I think there's something much worse than that coming. It's just not straight from here.
Yeah, so that's like the one last gasp of like I guess our system and how it currently works. So because I guess a lot of people are thinking that we've already had that, but you're thinking we have this one parabolic. I guess the Fed and every other central bank throw everything else they have at it. We get this massive push
Yeah,
up.
not even that. I don't
No,
think it comes from. I keep saying the Fed's not the story right now. And I'll talk about the Fed in a few minutes, but it's really not dependent. The big money printing will come after the bust. Will come after that 80% bear, or the latter stages of that. And that 80% bear is because I think we're going into a global bust after this last run up. But the run up is not really driven by massive printing or the Fed doing a huge pivot. They're probably going to pause at some point, and it could be before or after the November meeting. Who knows? They may have done their last hike for a little while, or they may, if we get some bad numbers on the economy and we get some accident, they could be done. But even if they're not done and they do another 50 or 75 point hike, I'm not worried about that. I don't think the Fed is going to be the story of the next 6 months. The bond market, as I say, the bond market leads and the Fed follows. I think the bond market made its highs in rates, a week ago or whenever, at 4% on the 10-year. It fell to 360 and is now back up to basically 375, 380. But I don't think we're going back above the highs. And, I think we're likely over the next 6 months to see the 10-year fall to 2%, maybe a little below. So if you get rates moving down, the Fed can do whatever it wants. 10 years is going to be dictating things a lot more than the Fed can. And as far as the Fed right now, it's so transparent what they're doing. Bill Dudley, who was former president of Federal Reserve of New York, and before that had been a senior economist at Goldman Sachs, good guy, but he had a speech in April where he talked about the fact that to tighten financial conditions to the degree we need to get inflation down significantly, we have to get the stock market down significantly. That too much, when wealth is held up, you're not going to slow the economy enough or get conditions tight enough to really break the back of inflation. So since April, that's been the mantra of the Fed, because Powell adopted that view. And it's so transparent right now in the last few weeks, particularly last week and this week. The Fed, every time they see the market going up, they want another Fed governor out there saying we're not anywhere near done. They truly, I think they're governing policy right now um, based on the stock market. Now, it used to be obviously the criticism was the Fed. There was a Fed put that every time the market went down, they'd come in and support it. And now it's just the opposite. They really want the market down sharply. Now, I don't know whether they think 3,000 is enough, or I've seen numbers thrown out there where Dudley wants even much lower than that. But it's nonsense. If you have a Fed chair or a Fed, an FOMC committee out there targeting the stock market, you're making a huge mistake. Alan Greenspan years ago in his famous irrational exuberance speech thought he was an expert on the stock market, and it was many, many years and thousands of points higher that the market topped out, and he was calling the top in a bear market then. So Federal Reserve governors should stay away from thinking they're market gurus or that they can dictate where the market should go. I think the Fed's going to have their head handed to them. If I'm right, they desperately want the market down. That's what you're seeing today. That's what you've seen the last couple of weeks. It's so transparent that everything they're saying is because they're targeting the stock market and trying to scare it. And the market's not really reacting now. It reacted last week, but it seems now, they get less and less out of those scare tactics. And at some point, the market's going to go completely opposite to what they're saying, just like it did Monday and Tuesday of this week. And you're going to see, them finally wake up to the fact it'll probably be hundreds of S&P points higher, but they'll finally wake up to the fact that, maybe our rhetoric isn't being listened to. But I have no doubt about what they're trying to do. Every single one of them is trying to up the ante on how hawkish they are, because if you remember in late July after the July meeting, Powell thought he was hawkish, but he made a couple statements in there that the street decided to take as dovish, and that somehow the Fed was done, and the market ran up for several weeks to much higher levels. And he then, before he went to Jackson Hole and gave a very simple one or two sentences, because he didn't want to be misinterpreted, and it was very clear what he wanted them to know is I'm very hawkish and I'm not anywhere near done. And that's been the mantra ever since. So what the Fed is thinking. They're being very transparent in a good way, but they're also trying to manipulate the market lower, and not trying to convey that, but that's very obvious what they're doing. So that being said, I think the market's going to ignore that and run up. The hardest thing for investors, I think, to grasp in my forecast, they go, I get your global bust forecast, which that's what I say is coming after the melt up, but I don't get the melt up forecast. How can we have a melt up when you're saying the economy's heading for a bust? You're saying the Fed's over tight. You're saying the world is in trouble. How can you go to major new highs? Well, the problem is you've got sentiment so bearish. It's at levels we saw in 2009. It's at levels we saw in 1982. It's at levels we saw at the bottom in 87. It's at levels we saw in 2003 at the bottom. Everybody's bearish. In other words, everybody's on one side of the ship. And all of a sudden they're going to realize it's not going any lower. It seems to be going the other way. And you're going to have them having to reposition. And I think what is being underestimated is just how illiquid it will be when everybody's trying to get through that door to buy things again. We talk about everybody trying to get out the exit at once, and it really sends the market straight down. Well, if everybody's trying to buy, there's not going to be the shares there. And I think you're going to see some, Monday and Tuesday were kind of precursors of what's coming. And I think it'll be even much bigger than that, where you get big daily moves because there's just not the the availability of stock for everybody trying to get in at once.
Yeah, I guess you could say there'll be some massive short squeezes probably for some big hedge funds, and that could even amplify the issue.
Yeah, I think
Uh,
as usual, what usually happens at these bottoms is short covering happens first,
okay.
and that moves, they'll move the market, a good ways, and then all of a sudden it's broken above certain levels, and then all of a sudden the bears turn into, hey, I can't sit here, with all this cash, or I can't sit here on the short side of the market. I've got to reposition, and so then you get the momentum taking over, and then I believe, at new highs, I don't know how much above new highs. Let's say 5,000. I think the last move from say 5 to 6,000, or it might be 5 to 7,000. That last move, I think will be straight up. It'll be FOMO, fear of missing out. So kind of short covering first, momentum buying second, and then FOMO.
Wow.
And and just to clarify, people say, yeah, but if earnings are, going south, how can the stock market go north? What will happen is if they feel the Fed is pausing, or that the Fed is done with tightening. I'm not saying they are, but if that's the narrative that gets picked up because they are slowing down, or they are giving indication that maybe they're not going to tighten much more, um, investors will begin to look over the trough and say, okay, this we can now start putting parameters around the bear market, or around the recession, and we can look over the trough to the next cycle and start putting out earnings estimates for you know latter part of 2023 and 24, and that's what the market will move up on. People think it's moving up on the next quarter's earnings. No, or down. It's not. It's really, and again, that's once the Fed shifts from being a headwind to a tailwind, uh, the market will shift from looking near term to looking farther out.
Yeah, and then so once it hits, it will have a massive run up, I guess, as you said, to end, and then we'll see a massive crash. I guess. What do you think will be what will be the turning point where people realize, like, hang on, probably everything that we were ignoring is actually real, and then this isn't looking good. Then the markets
Yeah,
go
it's
down.
it's not going to be a case. I don't think it's going to be a case where you go straight up, and then the next day you start going straight down.
Okay.
It's not that. The tops are a process. So once we get up there, what I can say is I think what's pretty predictable is that all the bearishness that you're seeing now, all the calls for lower and pretty negative viewpoints will be totally shifted to the other side, and you'll see maximum bullishness, and people will be arguing with me because at that point I'll be turning negative, and they'll be telling me how I'm wrong and that I don't understand that there's a whole cycle ahead of us, that this is just beginning. That will be the kind of the narrative at the top, I think. So it's going to be very hard for investors who, you know, kind of go with the momentum and go with the consensus. It'll be hard. Today they will tell you, boy, if we ever get 6,000, I'm selling. I can promise you, when we get 6,000, the majority of investors are going to be afraid to sell because they think it's going higher. And like I say, it may not be 6,000, it might be 7,000. I don't know what it's a blow off top, so it can go straight up and you don't really know the number. But I can pretty much predict sentiment, which will go from an extreme bearish level to an extreme bullish level, and that'll be your signal that you're close. Nobody's going to be able to tell you what day or what tick is the top ahead of time. It's only after the fact. So, but what you can look at then is that the risk reward has shifted completely to where it's all risk and not much reward. Any reward is really front ended and will be over pretty quickly. And once you're up there,
Yeah, exactly. So as you said there, then you expect, you know, it to come down. And you mentioned a secular shift as well. So the last 40 years, as you said, we've had a very positive secular shift for the stock market. So where do you think macro will shift to? What will change for the point where, as you said, that might be the the highest that we see for decades.
Yeah. So what really drove this 40-year secular bull market, and I choose 1982. Others will argue with me and say it started in 2009 as just beginning, et cetera. But I use the 1982 beginning because that was really the beginning of disinflation. Inflation peaked around then, and we had rates fall. The 30-year and 10-year fell from 15% down to 0.4% on the 10-year back in 2020. T-bills fell from 21% down to basically zero. So the last 40 years, you've had rates coming down, not every year or not every month, but rates coming down, trending down a long way for 40 years. And the inverse of that is the PE multiple. So multiples went from single digits up to mid 20s because rates went the other way. What we're going to see, and I do think we'll see a 0% 10-year in the bust. So next year, that'll mark the bottom in rates. And I say zero, but I think we may see a negative 10-year, a negative rate in 10-year, because the Fed's going to have to print so much money, and every other central bank too. Because what's happening in the global bust, the reason it's called a bust, is you're going to have a free falling financial system, global financial system. That means they will have to print money like crazy. Right now, what you hear is people saying, "Oh, QE is done. The Fed's not wanting to ever do QE again, or certainly not for a long time." It's not going to be very long. It's next year. I think you're going to see more QE than you've ever seen before, by a factor of several. So in other words, if we increase the Fed's balance sheet by $5 trillion in the last couple of years, I think we'll be increasing the Fed's balance sheet by $20 trillion in 2023-24. So I mean that's beyond anything we've ever done, and every central bank's going to be doing something similar. Different numbers, obviously, but proportionally similar. So we're going to see massive money. That massive money at first sends rates down. And like I said, we'll see a negative 10-year, I believe, because they're buying, to do QE, they're buying bonds from the dealer banks and pushing rates down because of their demand for the bonds. What will happen on the other side of the bust is all that massive money around the world is going to jumpstart an inflation cycle, the likes of which we've never seen. It'll make what we've seen this last year pale by comparison. It'll even make, I think, the early 80s pale by comparison. So you'll at least retrace that and probably more, which means, inflation back in the early 80s got up 20%. You'll probably see it 25 or more. The 30-year got up to 15%. May actually, it'll either get back there or actually go to a higher high. So if you get rates moving from zero, let's just use a 10-year, zero or negative, up to 15% in between 2023 and 2030. Imagine what that does. I mean, that's a whole different environment. And it'll be driven obviously by inflation going from, and I think the global bust is going to be a global deflationary bust. So I think next year we have deflation, not inflation. And so you go from deflation in 2023, by 2030, I expect it to be 20 to 25% inflation rates. That is just beyond anything anybody's seen, or beyond what markets can handle. It means you will have a cyclical bull market because of that inflation coming because of a recovery and too much money. You'll have a recovery, but it'll be a very different recovery. It'll be, rather than being driven by tech and growth, it'll be driven by reshoring, industrial stocks, commodity stocks in particular, more than anything else. I think oil prices can go to $400 or higher. So if you get oil going from, I'm calling for $30 WTI crude next year in the bust. If you go from 30 to 400 in 6 or 7 years, you can imagine what what that is for, you can see why interest rates are going to go up. If you get copper going, I think copper can get to $6 here in this last rebound. But then I think it can fall to maybe dollar or two. From that $1 or $2 in the bust, copper can go who knows where, $20, $30, I don't know. So it's commodity prices are going to go straight through the roof over a 6 or 7 year period. It's not going to take 20 years. So commodity stocks will do very well. Commodity producers will do well. The precious metals will do well. What won't do well are growth stocks that depend on declining interest rates. It's mostly you're capitalizing steady growth at ever lower interest rates. That's what the game was in the last 10 years and even longer. But what you're going to see is the opposite, where rates are going higher, it's going to squeeze PE multiples. So growth stocks won't do very well in that environment. And that makes sense. Every cycle is new leadership. Well, the leadership of the next cycle is commodities and industrials.
Yeah, and it makes sense if you think about if some stocks, I guess you could say internally they make like a 6% return on investment, but then if you're making 6% off bonds, then what are you going to choose? Which one's the less risky ones? I guess that's the challenge that a lot of these, as you said, a lot of these growth companies going to have, especially if they're paying higher multiples for their debt, which is
Yep. And the alternative, the commodity stocks, the reason they do so well is because they have price flexibility, so they can as the price of the products they're selling goes up, their margins go up. So if you're a copper producer, you're going to be coining money for a period of time. If you're an oil producer, you're going to be coining money for a period of time. And of course we know these green policies around the world are creating a problem because we're nowhere near a point where we can shift and have the electricity or the infrastructure ready for green energy. And the alternatives can't replace oil that quickly, oil and natural gas. So but while you're restricting supply and putting pressure on companies not to expand supply or research for supply, you're setting up a next cycle where you're going to have demand go through the roof, and you're not going to, it takes a while to build, to drill for new oil, to build rigs and do all the things that you're going to have to do. So that period from 2024 to 2030, you're going to see huge capital expenditures in the commodity area as they try to expand supply, try to exploration, production, et cetera, in energy, in mining, and all kinds of commodities. I think you're going to see a lot of capital expenditure because the prices are going to be there to justify the investment, and that includes precious metals. I fully expect gold to get up to something above $10,000, and it might be $20,000 by the end of the decade. I expect silver to get up to say $400, maybe higher. So there's big upside in these things. When you're looking at silver today at $20 and gold today at 17 something, 1700 something, you can see there's just massive run up in prices if I'm right. And that'll correspond to very sharp increase in earnings over that cycle.
and where do you see the S&P going? Do you think it'll just sort of, I guess, maintain and just continue sideways a little bit, or what's your thoughts on it?
That's a great question, because what I think people don't understand is for the last several decades, it the smart investor just went into passive investments. If you had an S&P index and you invested 30 years ago, you outperformed pretty much any money manager, or most money managers anyway. And all you had to do was buy an index fund, which didn't have high management fees. It was least costly, and it gave you great returns. And that was because interest rates went from 15% down to almost zero. If you get the opposite, where you go from 0 to 15, the you know the indexes are going to struggle, because the index multiples are going to, market multiples are going to get compressed. Even if you have dynamics within the index where, they're going to own some of the things that are performing, but they're going to be heavily weighted in last cycle's winners. So you can have all kinds of tech in there. You're going to have, all kinds of healthcare in there, and consumer staples and consumer stocks. And that's not going to be the winners of the next cycle. So you're, at least for the first several years, the weightings in the passive are holding you back, right? They're getting crushed because the multiples are getting squeezed. And that's not being made up for because the stuff that are the winners are still low weightings in the indexes, because they were last cycle's losers, or, not the winners anyway. So it really is going to be a situation where after 30 years or more, investors are going to have to change how they see things, because if they just say, I'm doing business as usual, I'm fully invested, I just stay in my indexes, they're all of a sudden going to say my indexes aren't performing, I'm getting hurt. And they're talking to their neighbor, or some guy at work, and he's saying, yeah, well, I'm buying commodities and I'm killing it. So, I'm buying commodity producers and, precious metal and mining companies and stuff, and I'm doing great. And you'll see a gradual shift. That's how cycles work, is you don't have everybody moving at once. You'll see it gradually shift over the cycle. And then by the time you get to the end of the decade, I think you'll see, the indexes will be heavily weighted towards industrial and commodity, and underweighted in tech and healthcare.
Yes, it's interesting. So, if we look at, the 1930s, the US, if I'm not mistaken, they actually banned private ownership of gold, and a lot of the metals were, basically only the government could have metals. Do you see something like that? And sorry, I'm not sure if it happened in other countries as well, but do you see something like that happening if they get desperate?
I know that's out there. The problem is, I think this run up in the metals, it's obviously not an issue now. I mean, the metals are probably the cheapest asset out there. They have really underperformed, and have, are at, relative to stocks, relative to other assets, gold and silver are as cheap can be. And so it's certainly not on the radar now. Who can predict what will happen in, let's say, the early next decade? But I don't think it's not a central bank issue right now. Central banks do not have their focus on precious metals, because precious metals are so out of favor and not causing a problem at all. And frankly, right, if you look at the global bust next year and they have to print like crazy, um, they're not going to want a gold standard. They're not going to want, they're not going to, people who are pushing for a gold standard. Yes, we need monetary discipline. What I'm forecasting is a disaster in the long run. I'm not, as I say, I'm not endorsing what's coming. I'm just forecasting what's coming, because it's pretty predictable what's going to happen. Um, the time to have been on a gold standard was when we came off the gold standard. We should have stayed on the gold standard, and it would have avoided a lot of the problems we have today. But to go on a gold standard now, as I like to say, we'll all be living in caves if they tried that. Because what you'd be doing is letting a global financial system implode and have no response for it, because you have your hands tied with gold-backed currency. So that could come next decade, but in this decade, there's not a chance. I think gold and silver are off the radar. Crypto, Bitcoin, or I should say, the central bank controlled, digital currencies. And that's not my field. I don't think they're going to play a major role or change what my forecast is, but certainly, that's more the focus of the central banks now than gold and silver for sure. So who knows what will come out of that? I know there's people out there very concerned about that, and what it's going to lead to. But at this point, I don't. I just don't think that's an issue either. I think that's longer term could be, but not in the next couple of years.
Yeah, it's fascinating. So, David, thank you so much for your time. I really appreciate it. I guess my last question is, what is the one message you want people to take away from our conversation?
Yeah, I guess probably the biggest thing is to understand that the popular narrative out there is not oftentimes, or certainly at turning points, not often right. And it's easy to listen to because everybody's repeating it and it sounds so logical. That's why it's the popular narrative. But just understand that at major inflection points, and I think we're at one right now, going with that consensus is going to leave you, way behind the eight ball. And it'll be, and probably kind of the add on to that is that if in fact I'm right and we get this big final blow off rally, don't view it as the beginning of something much bigger. Understand that it's the last hurrah, not the beginning of a big new cycle.
Yeah, as you said, if people get too negative, be cautious. If they get too positive, be cautious as well. It's always
Yeah.
understanding at
Yeah.
the extremes. So yeah, thank you so much. So if anyone wanted to find out more about your work, I know you've done quite a few interviews online, and you have a Twitter. Those are the best places to find it.
Yeah, I'm typically on Twitter every day, so they can find me there at Dave H. Contrarian. And I should say, I have a lot of followers, and every once in a while I get followers coming on and going, "Where have you been? I haven't seen any of your stuff," and I'm on there every day. The problem is they want to see original tweets, and I don't do a lot of original tweets anymore because when I do, I get a tweet storm that just gets too unmanageable. So I'm mostly responding to questions and things. So they have to look at both tweets and replies. They can't just look at the. There's plenty of people that disagree with my view. So that's you'll see people very critical of my view because it's kind of extreme. But there are plenty of supporters too. So
Yeah, awesome. I'll put that in the description below. But yeah, David, thank you so much for your time.
okay, thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.